All right, everybody. We have one more session for you this afternoon. Of course, don't forget, we are doing Q&A. There are microphones. By now, you should know the drill, but in case you don't. And for our last session of this fine day, we're going to talk about my favorite thing, which is liquidity. Now, everyone wants more IPOs. We all want more mega deals, but they are a little bit thin on the ground in the last couple of quarters. So if you want to retain founders and staff that have been partially paid in stock and there's no real return on the horizon, well, how do you manage that? So we have a whole panel to break down that key concept. So please welcome to the stage your moderator. It's Becca Szkutak. We also have Amir from Switchboard, Maria from Beacon Capital, and Tyson from Notice. Thank you. Welcome to the stage.
Thank you.
All right. Okay.
One of the benefits of working at a startup has always been the potential upside an employee can get from stock options when the company eventually exits. But in today's market, guys, what's an exit? Exits are few and far between. And of course, that's not the only way you can get employees can find liquidity. And maybe companies can use employee liquidity to sort of keep the momentum going now that an exit maybe looks further away, or a way to just keep people engaged in sort of building, because startup is such a long journey. But Tyson, is it really that easy?
It can be. I think that if it was 2021, I would say pretty easy, pretty easy. I think that in this market, the bar is certainly higher when you're looking for secondary liquidity. I think that buyers are more picky. I think there's also challenges with cap tables nowadays. The big investment rounds have kind of made it difficult for common to be valued at a level that would be acceptable to most employees. And so there's some complexity there, but I think it's definitely possible. My answer would be yes, it's absolutely possible.
Mm-hmm. And Amir, I wanted to ask you as well.
First, I disagree with Tyson.
Oh, let's start there. Let's start there.
I think it's actually really difficult. I don't know how many in the audience sold shares in a secondary market. I bet it's less than 5% of the people we have here. I wish we had a secondary market like NASDAQ, where there's enough demand and there's bidding and pricing is obvious. The reality is so far from this that it's even hard to describe. So I disagree with Tyson, although he's an expert in the field, but I think it's for employees, it's actually really difficult to realize the value that they worked so hard for. This is something that as an industry we have to fix.
Mm-hmm. And following up on that, I was going to ask you, since Switchboard is not your first company, you've sort of been through this process before, companies in the past. How has employee liquidity and sort of how companies think about these stock options changed? Yeah.
So Switchboard is my sixth company, and every time you start and you think you're in a market and you compete with certain number of companies, you actually compete with all public companies, and you compete with them for talent. And all public companies have the advantage of public currency. So if there was an easy way to make it available for employees, I think that would have been great for all founders of early stage startups. So I'm in Switchboard. We're doing a collaboration platform for people that want fewer meetings. And it is still difficult to provide the liquidity that we want to employees. Before that, I had one company that went public, 3 that were acquired. I remember, I can probably list on 2 hands the number of instances that we had where we managed to give liquidity to employees before the public IPO.
Mm-hmm. And could you talk a little bit about what your strategy and approach looks like currently, your current company?
Yeah, so the truth is that there is so much, we as founders, as CEOs, our main obligation is to build successful companies. And there is so much that we can do to help and facilitate the process. Like we can be transparent, we can be supporting it. But there are market and regulation obstacles, friction that is making it very difficult. So when I saw the need, I also invested in a company called Equity B that is providing some kind of solution for this. And their solution is not actually to buy the shares, but to do a forward contract that is giving the employee most of the future value without the risk. And I think this is one approach that can work for employees and for companies to provide early liquidity.
And this obviously is a topic that's sort of, you would get a different answer if we were talking about an early stage startup, we're talking about a late stage startup, as well as talking about the employees versus the actual founder themselves. And Maria, I'm curious, because you come from the European market, well, how is it different over there when you guys talk about companies and founders offering liquidity?
Well, how many Europeans do we have here? Oh, good luck, guys. All right. So let's tell the Americans how it works over there in Europe. It doesn't. Founder liquidity is something that happens after the Series C, I would say, comfortably. Series B is debatable, and Series A is almost always a no. There are two reasons. One is cultural. When the angels go in, typically, and I've been an angel before I became a VC, so as an angel, the mindset is, no, I will first get money out before the founder gets any money out of the company. So it's a cultural thing, but also it's a systemic, a structural issue, because most of the funds have capital from the European Investment Fund, from the British Business Bank, and they do not like secondaries. They do not actually allow the funds to invest in secondaries to give founder liquidity. So we have a systemic as well as a sort of a cultural issue. It's starting to change now, and here is why it's changing. Because as there were more unicorns, there is more confidence in the ecosystem, liquidity starts flowing earlier in the system, but still it's trickling down. And the problem, the serious challenge that you have in Europe because of the lack of liquidity is that founders are more prone to accept the suboptimal exit. That's why you see quite a few exits at sub-billion. You will have 300 million, 400 million exits, and that's because the liquidity, it will take a lot more time, and at some point the founders say, right, I'm cashing out, I need to raise a family.
Mm-hmm. Yeah. And sort of looking at how companies can think about this from the beginning. You're just starting to hire employees, you're just starting to put some of these more set standards into place as you're looking to build the company. How should founders think about employee liquidity, maybe their own liquidity down the line when they're just starting to build? How can they set up these programs? So
this is totally confidential, right? It's like nobody's going to share.
No one's taking notes, right?
Yeah, nobody's taking notes. So first of all, as founders, there are ways to take care and make sure that that the secondary option is going to be available to you in later stages. I'm not a legal expert, not a tax advisor, but there are ways when you form the company to make sure that some of your common shares will be transferable to preferred class. Maria, I'm sure you know more about this than I do. But you can make sure that your common share can convert to a preferred share after a purchase. The other thing that is really important is choosing your partners, choosing the VCs that you work with. What is their approach? Maria talked about cultural resistance from the venture capital side to liquidity of founders, like how strong it is with your founders, with your partners. I think this is, at least historically, that was one of the main obstacles, and it's really kind of stupid because basically it puts the founders and the VCs in a completely competing, misaligned interests. As a founder, if you start a company, you reach 100 million in value, you still own 20% of it. Wow, that's amazing. It's a life-changing. You want to get out. For the VCs, this is meaningless. It doesn't matter if they sold a $100 million company. So I think the more VCs can do to help founders be on their side and go for the big exit and the big, or even building a big company, the better it is. So the most important thing is find the partners that will work with you on this.
Mm-hmm. Tyson, Maria, what do you guys think?
Go ahead.
It's very interesting what you're saying there. How can they preemptively start thinking programmatically about the liquidity? And one of the things we've seen, and it's very encouraging, is founders start building in the SSAs of the Series A round the ability to sell up to 10% of their stock between 5 and 10% of their stock without perhaps the approval of the entire shareholder base, but just the approval of the board. What you're doing this way is sort of preempting the conversation that, hey, I want to be able to do that. Now, let's not go to the other side of, all the way to being able to sell 20, 30% of the business at Series B. That won't work. What you want to do with founder liquidity or liquidity for the C-level, the employees, is to use it catalytically for value creation within the startup. In other words, sell a little at the appropriate time so that they get encouraged to build even more value for the business and the shareholders. If we start thinking like that, then we will start thinking win-win about both the opportunity and the challenge that we have with lack of liquidity in the ecosystem.
Yeah. That's a really good answer. Yeah, I think that it's oftentimes called Series FF shares in the U.S. For the founders to take 10% of their stake that can be sold and things like that. I think that's a good signal to future investors that, hey, this is our intention. And I think I think founder liquidity is oftentimes a bit easier to come by because at least in 2021 it was kind of a deal term. A lot of funds would say, hey, you should really take money off the table. That's why you should let us invest. And it was pretty heady times in that period. I think that Series FF is a good way to do it. Obviously, you got to build a valuable company, and you need to have kind of excess demand beyond what the company needs. So if you're trying to raise $10 million and you have $10 million of investment, you're not doing a secondary because no investor is going to say, oh, you want to take what the company needs and just take it for yourself? That's weird. And so I think that's the key is you kind of have to have an excess of demand. What I think is interesting is what some companies are doing that get much larger is programmatic liquidity. So thinking about this from the perspective of, hey, we're going to do quarterly sales in an organized way for our employees. And I think that's something that requires you to kind of, at that stage, these are champagne problems. You're doing very well if you have demand that would come back quarterly to buy more common stock from your employees. But that's something that I've seen some of the best companies doing. And the opposite of that would be companies that completely block transactions, which is pretty busted in my view. I think that a couple things. I was a private placement broker, so I was helping employees and shareholders sell stock for several years before doing what I'm doing now at Notice. And I hear things. The company will say, "Oh, we're blocking transactions to protect the validity of our cap table, and we want to know who our investors are and all this stuff." Well, the reality is, you block transactions, and then forward contracts happen. Now you have no idea who the beneficial owner is, or SPVs happen, and SPV interest trade, and all this stuff. Like when there's demand for your equity. These what used to be very exotic have now become very mainstream instruments that a lot of funds have included in their mandates. And so you're never really going to stop it. And there's downsides, right? I mean, in the kind of the peak in 2021, our Notice does real-time pricing for mid to late stage companies. And, the valuation of Stripe was $211 billion in the secondary market, and they were blocking transactions. And then now it's $50 billion, which is, oh, boo-hoo, it's still $50 billion, but that's down 75%. So, you have Instacart went out today at roughly a $10 billion valuation, and they were worth 40 in the peak, and they were blocking transactions. And so I just think you kind of have to think about. I think you kind of have to think about liquidity for yourself as a founder. That's great, but also the culture you're trying to build, and like thinking about it more for your team as something that can be an HR benefit almost over time. And the reality is, some people will say, oh, well, if they get liquidity, they'll just leave. And it's like, well, what kind of culture do you have? Like. Someone gets a couple $100,000 and they just leave, okay, maybe they should leave. So I think it's more of a holistic conversation beyond just your own personal liquidity as a founder.
I want to give a practical advice to founders. I assume there are many founders here in the room. Founders that think, oh, I'm going to sell when I need, find it that it's almost impossible to sell when they need or when they want. You can sell when you solve a problem for someone by selling. So, for example, my first company was shopping.com. You're going to make fun of me, but it was in '97. The valuation was $3 million. We wanted $3 million. The VC came and they wanted $2.5 million. There was a gap. Funny, right? Yeah. Today it's like the pre-seed. It's like, my co-founder basically came with this great idea. Okay, we'll agree to this valuation, or you'll agree to our valuation. We're going to give you the ability to buy some of our shares, just a little bit of our shares. We're basically going to give you the option for a year and a half. And after a year and a half, they exercised this. We made a little bit of money, and that was nice. That was a way to solve a problem and provide future liquidity. By the way, the VCs immediately said, oh, but it's going to be like an exit for you. And my smart co-founder immediately told them, no, it will be an exit for my wife. I will be here and I'll keep on working. So, yeah.
And I want to circle back to something you said, Tyson, about how like companies blocking their employees from being able to sell share options. What does that signal to their employees, and sort of why should companies maybe try to avoid that mindset, especially if they're looking to do hiring in this sort of softer labor?
Yeah, I think it's, I haven't worked at a real company ever, so it's hard for me to know, but I've heard other people say when they go in for interviews, they show them a sheet, and they say, oh, this is what your equity could be worth, like our last round was this, the 498 is this, and here's some numbers, and look at that big number, isn't that great? This is why you want this low salary, right? And like that's kind of what gets presented, but they tell you like, oh, you're never going to be able to sell it, like you can't sell it. That's less known to employees, even folks that have been working at companies for years. And so I think, I just think that like creating some kind of a program around it, right? Like finding an investor that wants to come alongside you that's going to periodically want to continue to size up and be kind of either ROFRing transactions, so exercising your right of first refusal and directing transactions to a preferred investor to keep your cap table clean, or just having this program. Again, this is a champagne problem. You can't do this at Series A. You have to do this when you've created a tremendous amount of value for your business. But it is a way to retain staff, because then when you're interviewing new people, you can say, hey, here's your equity, and not only that, but every quarter you can sell this much. And this is the history of what we've been doing, and here's where it's at. And it's also great price discovery in a lot of cases. You can kind of figure out what the market's telling you, and you don't have to, Instacart did like some 498 markdowns where they marked down their internal valuation a couple times after the pandemic. And we were tracking things in real time in the secondary markets, and we knew it was way lower. And they lowered the 498, and then like 2 months later, they'd lower it again. And that's not a good look. I think it's good to be out there in the market and really know what's happening so that you can be more precise about things. So I would say don't be afraid of the secondary market. If you're a founder, don't be afraid of it. It's the truth. You need to know what's happening. Don't let the lawyers tell you can't do it, and just tell them to figure it out. Like that's the key. Is that fair?
Tell them to figure it out.
Tell them to figure it out, yeah. Other people do it, why can't we do it? Just figure it out.
I think that the elephant in the room is that we're talking about this world where people can sell and so on, but the truth is that 55%, historically, 55% of the options are not even exercised. And you'll be surprised in bad times, or not surprised, but in the last year it was 72%. So many people that have a significant contribution to building extremely successful business basically finish this journey without what they deserve. And I think that that is what needs to be fixed, and this is the motivation to be fixed. And I don't know if like equity B and forward contracts is the way to solve it. I don't know if there is another way. Maybe brokers is what you need to work with. But as an industry, it seems to me like really wrong that people are not getting a fair value for their contribution.
Yeah, and sort of building off of that, how transparent or how should companies and founders sort of set expectations for their employees? Because I know we all know this story. You come in, you take a lower salary, you have these big potential upside from these employee stock options, but then what if the company sells in 2 years at $250 million? You saw the pricing laid out for a huge exit, an IPO, and that's just not the reality. And how can founders, when they're setting these things up, how can companies kind of set the right expectations with these employee stock options while still making them a benefit at the end of the day?
For me? For them? For me? I don't know. So I think the only thing that we can do is be completely transparent. So sometimes I interview people and told me about other offers they're getting, and the company is refusing to say what was the last share price. They're refusing to say how many options, how many shares there overall, and it's kind of stupid. So I asked, like, how are you going to evaluate this package if you don't have this basic information? So I think that, again, the best approach is to be completely transparent, but also to be careful not to set expectations and no indication of what the future value is going to be, because honestly, as founders, we have no idea. It can be anywhere from 0 to the moon. So, like, give people all of the information that they need to put their assumptions, make their calculation, and come with their value, future value number.
What we've seen, but that again is the European perspective, which perhaps is a more sort of a less, on that aspect is a less mature market. But what we've seen is that the more courageous CEOs will gather the interest from their employees, especially from their valued employees, who is likely to want to sell and why. What are the reasons behind it? And in the first available opportunity, they will create a sort of the opportunity for liquidity. So we had founders in our portfolio who, when one of their employees wanted to sell, they pick up the phone to the existing investors, to investors that they wanted to come in the last round, and said, hey, would you be interested? This is the opportunity here. This is what would like to happen. So proactively, they went out of their way to help the C-level executives to get some liquidity out of their vested options. Yes, it takes some legwork, but it shows courage. It shows commitment. It shows sort of a conviction in your ability to use your stock to keep your most valuable employees.
Mm-hmm. And sort of switching gears a bit, because we've talked a lot about employee liquidity, but looking at founder liquidity too. Maria, I know your fund, Beacon Cap, does some fun things around founder liquidity. So when you guys are working with potential companies, what are you guys looking for when founders approach you about potentially taking some liquidity off the table?
There are a couple of things in terms of the liquidity itself, the parameters. First of all, we as a fund like to invest at a particular sort of particular stage is when the business will have reached 5 million ARR. Typically, we call that Series B, at least in Europe. Again, nomenclature can differ from depending where you are in the cycle. So where you are in the ARR, how much are you growing? Are you a valuable sort of business in our eyes? Are you likely to go for a sort of a supersized exit? And then we're looking at the founder, and there are a couple of things there. The founder and the founding team needs to have served time, so to speak. You cannot have a founder who started yesterday and a year later to be seeking liquidity. You want to have seen a sort of 5-6 years into the business, to have sweated, to have really worked for the business. You want to see a sort of a relatively modest liquidity at the level where we are coming in. Again, this is Europe and this is Series B. So you don't want the founder to start taking 10 million off the table. You want the founder to ask for 1, 2, 3 million. Why? Because this is how much, this is the cost of living, essentially getting a property in London. This is the cost of putting the kids through the schools. Just to feel comfortable enough, get their wives, get their mothers off their backs. Imagine founders who have been through university, have racked up costs, and then they started their own startup. Imagine what they feel when they compare with their peers who went to investment banking and they make 2, 3, 4 times this money. So what we want is to remove any doubt that what they're doing is the right thing and that they should want to continue doing that for another 7 years to get a big exit for everyone. So that's why I say that we want to give liquidity when it is of strategic reason and it solves a problem. In our case, it solves the problem of accepting a suboptimal exit.
Mm-hmm. And are there any red flags you guys look out for from founders? Can founders try too early? Can they ask for too much? Have you seen weird structures? How can founders approach this without making themselves come off as a red flag?
We're going to find out after this panel whenever it comes to talk to her.
I would say the business needs to be, back to your point, Tyson, needs to be well-funded. So as a founder, you cannot be asking for liquidity when the business is starving of capital and is having a sort of a runway challenge. It is not the right time to open up this conversation, and probably you will get a no from your existing investors who will block it. So the business needs to be in a stable footing. It needs to be growing aggressively. You need to have shown that you are able to secure the capital required to fuel this growth. And the ask needs to be proportionate to where the business is, how much time you spend investing in this business, And that's why I'm saying, well, we're talking about a couple of million at Series B rather than tens of millions. That's what would be the biggest red flag. Also, in our case, when we're giving founder liquidity, we do due diligence. So we want to feel with the founder that we are entering into a partnership. Essentially, we want to feel that we are becoming part of his or her inner circle that will open up the books, will allow us to appraise the opportunity, and we will enter into a long-term partnership. We'll be there for him or for her until the exit. And this is a trusting relationship that is built not overnight. It takes some time in the same way that it will take time to raise a round. It takes time to secure founder liquidity.
Mm-hmm. And I know may not be super surprising for some of us in the room, but that strategy is pretty unique. A lot of VCs, especially in the earlier stages, early even being Series B, Series C, aren't a huge fan of founder liquidity. And I'm curious sort of how, you mentioned this a bit backstage, how you guys can do this and sort of offer founder liquidity without stepping on the other VC's toes or sort of making the other investors not want to work with you. And I know, Amir, get ready, I'll be asking you about the same thing.
Okay, how many VCs do we have in the room so that I know how many people I'll piss off? No,
we're good. Okay, great.
Oh, all right. Okay. When we do founder liquidity, especially when we will do it what we call off-cycle, not as part of a funding round, we have three stakeholders: the founder, the shareholder base, and the board, which typically will be managed or controlled in a way, because of the investor director rights, by the most powerful investor in the last round. So you're trying to create a scenario that it is win-win for everyone. Once you have the sponsorship from the founder, you could play the founder against the VC. Good luck, that's a losing strategy, because all you're doing is you are dividing the very board and the very sort of relationship you want to work well in the future. So what we do is get sponsorship from the founder to float the idea, to present the idea to at board level. And you want the yes from the investor director, from the lead investor in the last round. Now, if the investor sees that the founder is asking for too much liquidity, he will try to block it. He or she will try to block it. So everyone needs to play good in the sandbox. Everyone needs to play friendly, and we need to all remember that the reason we're doing the founder liquidity is to remove financial concerns, financial risks for the founder, so that the founder can focus freely on the 1 billion plus exit. And this is our line of argumentation. Is it always accepted? Not always, but when the most sophisticated end of the investors, they actually like it. They see us as a solution to the problem rather than something that they would feel wary about. Just one final thing. Also, we don't play big discounts. We don't play in the situations where there will be 50-60% discount on the pricing, which again alerts the existing VCs on what's going on here. What exactly are you playing? Because they will then have other issues of how they carry the value on their books, but also simply because you're offering liquidity doesn't give you the right to apply a 60% discount on the previous round, especially if the business is doing well.
Yeah, and I'm curious, Amir, if you've run into any pushback over the years, or thinking of these different, both founder liquidity as well as employee liquidity that you've heard from your investors?
I think the conversation that we had and the great description from Maria about the process just illustrates for everybody how difficult really it is to get those kind of deals, how rare they are. And I think that is the honest situation, and I want to see more companies that are creating basically an overall program for employees to take advantage of deals like this, and less to make it like a privilege that really is available only to the founder of the company. There is no reason, if the founder is so incentivized to do it, there are probably a few other employees that are in an equal situation. So As I said, I've seen only a few deals like this. Every time it was something like Maria described. So yeah, it's pretty sad, but it's good that it's the last session of the day, so you can go and drink later.
Can I add one thing? Can I add one thing?
Of course.
Yeah, the one thing I would also say is, we're talking about liquidity in different ways. Some of it's kind of like company-sponsored liquidity. So a group comes in like Beacon and says, we want to do this thing, and you talk about the board and you kind of agree to it. There's also the secondary market, which people will talk about, and that's individual investors. And I mean, I don't know if you probably go direct to the company, but there's some groups that will actually reach out to a founder, an early employee that's still there or maybe has left, and they will want to buy shares from them directly in this secondary market, and that's where brokers get involved, and there's lending platforms like Equity B and others, and there's kind of all different structures that are out there. And I think that ultimately, like what I would say, and as a broker, I saw this a lot, and I even see it now with our data platform is, when liquidity is approaching you, it would be very good if you took some, because I think everyone wants to believe that, oh my gosh, we're a rocket ship, we're killing it, this is always going to be available to me. I'm going to wait until it doubles again. And it's like, It's kind of like the eye of Sauron, the market sees you and they want you, and then it's just onto something else. And liquidity can evaporate immediately, and within a month sometimes. And so when you do get opportunities as a founder or to do something more programmatic for your own employees, I would say, even if it takes some pushing internally, like really pursue that, because Beacon may want you today, you may miss some milestones, and then maybe it's they're onto something else. And so don't think it's always going to be there, because unless you're SpaceX or one of these companies, it just isn't always there. It's episodic, and you should know that as a founder. And anyone tells you different, they're not telling you the truth. So
it's the best advice of the day.
And a reminder for the folks in the audience: if you guys have a question, definitely approach the microphone, flag your hand so I can see you. Yeah. Go ahead.
Hey, everyone. So what would you recommend for the pre-seed startups, how to allocate shares for team members, and how would you structure, like, overall, if you have like 2-3 main founders, and how many shares you should allocate for the team members?
So the question from the audience is, as a pre-seed founder, how should you approach this? How many shares should you issue, et cetera?
Yeah, so they're pretty well-known standards on what should be but you're basically asking about the size of the pool that is available for options, and every company is different, and it depends on how many founders you have and what kind of round. But my experience, I found that I do need about 15 to sometimes 17% of the company available over time. It's getting And it depends, again, on the situation and what kind of functions your co-founders actually cover, how many senior executives you will need to bring to the room. But you need to do a budget just like you do for money. You need to do a budget for options.
And bear in mind that in every round, the investors will top up the options pool. So in every round, typically until Series B at least, the investors will say, right, let's top up the options pool to take it back to 10%, because the whole point of the round is to recruit talent, and talent will need to be incentivized with options. So you have to build that in mind.
And for early people, set aside 10% as like Series FF shares or something that can convert and be sold in future rounds, just in case. Yeah.
Thank you.
Can I have a question? I would like some. Sorry, I'm down here.
No, go ahead.
I would like to know what advice you would give. Like, there's power dynamic. I mean, I work for a nonprofit, and there's always power dynamic with funders. And through the years, I have learned that there is nothing better than always speak with the truth. It's the best thing. But when you are new in the field, and you are for the first time, in front of a possible investor, and when you are meeting someone, you want them to be very transparent. But what have you learned as a strategy for you to break that barrier that sometimes might interfere with you seeing the real person?
Mm-hmm. So the question from the audience is sort of, how can you break down the power dynamic and sort of find that transparency with who you are speaking with?
So first of all, I disagree with the power dynamics. Like, if I read between the lines, you meant like the VCs have some amazing power over the founders and so on. I actually think it's the reverse. I think there are very few great ideas and great teams that can execute on them. And VCs, excuse me, Maria, really are giving you the absolute most commoditized commodity.
Yeah.
So I think that, first of all, you should go with this approach. You have something unique. You're working on something great. You have the potential. And Sand Hill Road is full with VCs. So that's, first of all, the approach. Then you need to understand, okay, what are they looking for and what are they trying to do? And basically, they are trying to minimize risk. And your job is to help them understand how little risk there is in your venture. And that can be technology risk, market risk, the team risk, different kinds of risks. And be proactive about this. I don't think the thing is to be overconfident or overselling. It's just to be very specific about your plan and also being proactive about talking about those challenges. If you think that the VCs are not going to ask you the right question, it's usually not the right tactics. So just be upfront, talk about all the challenges, have a plan to mitigate each one of the risks, and find the right partners.
Remember, guys, the VCs have power until they write the check, and then we are the most exposed party you can possibly have in your organization, because there is very little we can do. Yes, there are all these terms and consent matters and control matters. It's all BS. Yeah. We can do nothing the moment we hand over the money. So it's back to your point. No, it's not. The power is on the other side, definitely.
We have the best job in the world, let's admit it, founders. No, seriously, we do what we love. We're getting paid for this, and we still have a massive upside. Like, be a founder, start a company. That's my advice.
Hi, my name is Ayush. My question is kind of a follow-up from the previous question here. As a pre-seed, I don't even know if I'm pre-seed, pre-something founder, I'm not focused at all on these questions. I'm just focused on building. And so at a high level, should I just, when I raise, trust my VC to kind of help me solve these problems, and I just try to pick a VC who has a good track record? Or do I trust my lawyer firm to do this for me? Or do I just read the entire internet and figure it out myself? How? This is quite intense. So
you said trust the VC?
Yeah. I had to laugh.
I feel like didn't hear
Yeah. So, pre-something, right? So I don't know.
Look, I think if you go with a lawyer that's specialized, it's like a Gunder or someone like that, they're going to be able to give you a range of, kind of a range of where people are typically landing right now, something that's defensible you could take to your investors, and you can say, well, look, Gunder says this is fine, or this is within the reasonable allocation. But you should ask about a lot of the things that we talked about today. I think you should ask about, do a little bit of research. A lot of it's going to be driven by you. If not, they're just going to give you the stock documents. You're not going to read them. Who does? And you're going to go forward. And later on, you're going to say, oh, I really wish I had taken a few more minutes to look at that and maybe asked a few more questions. So I think if you get the right lawyer, you can rely on that. After all, you're their client. I wouldn't ask the VCs what they think. I mean, I love, they're great, wonderful, but you're going to get a very different answer.
I feel like a whipping boy here. Thanks, guys.
You can ask her, but no other VCs.
Also, I think that people, the question is, okay, what's the brand value of the VC? Like, how much should I prefer a brand name VC? And I think that when you look at the term sheet, the most important thing is not the header of the letter, but really, what are the terms? What are you signing up for? What kind of preferences and rights this specific investor is looking for? And then after that, I would ask, who is the partner that you're actually going to work with? And how much this person specifically is a good fit for you and your company. And then Gunderson can definitely help you get a...
Don't ever get a VC unless you speak to one of their portfolio companies, guys. You reference the hell out of us in the same way we reference you. You need to know, how do we play when the things are not going well? That's the most important question I would ask if I wanted to work with a VC. Would be, show me a situation where things were not well, and give me the company name and the number of the CEO. I want to talk to them.
Totally.
Thank you. This is very helpful.
So I have a question that lends back to the employee liquidity. You mentioned in '97, your exit was only at 3 million. Now we're raising rounds at friends and family and pre-seed, and the trigger points on these qualified rounds to even enter that 409A, the valuation, to set the strike price is kind of like $10 million raises. So it's pushing that out years, to raise a friends and family, to go into a pre-seed, to go into a seed, before you're even seriesing the round, that a employee would even have the ability to even go to a secondary market. Do you see value in lowering down those qualified round trigger points to maybe converting people into a 409 like way quicker, having that series round faster, or just still kind of follow that cookie cutter, $5–10 million trigger before a qualified round happens?
We have 30 seconds.
That's for the experts.
I would say that I would not optimize for that. I would do what's best for the business first and foremost. Ultimately, a secondary market's going to be built around your company because you're doing very, very well. Oftentimes it's a little bit later. And so pre-seed very often, there's no, unless you're the hottest thing ever, there's no market anyway. So I wouldn't worry about that. I would think about that a little bit later. So some of the things we talked about today, so you're ready for it, and tell your team, how you're going to approach it. And then if you're lucky enough to build a business that's doing well enough to have a secondary market emerge, you'll be ready for it.
Perfect.
Sure.
And unfortunately, that does put us at time. I know it looks like some people still have some questions, so hopefully we can answer those outside of the stage. But please join me in thanking the panelists today.
Thank you.
Thank you.
Thank you.